What are lags in monetary policy? Have you ever wondered why changes in monetary policy don't show immediate results? Let's break down the concept of lags in monetary policy and how they affect our economy. Monetary policy lags refer to the time it takes for changes, like interest rates or the money supply, to impact the economy. These lags can be long and vary widely, often taking several months to a couple of years. There are three main types of lags to consider. First, we have the recognition lag. This is the time it takes for policymakers to realize that a change in monetary policy is necessary. They need to identify economic trends or issues that requiring intervention. Next is the implementation lag. Once a need for change is recognized, there is a delay in putting that change into action. This delay can stem from the decision-making processes within central banks. Finally, we have the impact lag. After a policy is implemented, there is still a delay before its effects are felt in the economy. This happens because many economic transactions involve contracts or agreements made months in advance, which do not immediately respond to policy changes. Several factors contribute to these long and variable lags. One major factor is contractual agreements. Many transactions are based on prices and quantities agreed upon well before they are executed. For example, a company might sign a contract for raw materials months ahead of time. This can delay the effects of monetary policy changes. Another factor is the behavior of businesses and consumers. They may be slow to react to policy changes, especially if they see those changes as temporary. This can lead to delays in investment decisions or changes in spending habits. Additionally, some firms may not frequently update their pricing strategies due to the costs involved. This can make them less responsive to immediate changes in monetary policy. Understanding these lags is important, especially from a conservative viewpoint. Conservatives often advocate for fiscal discipline and limited government intervention in the economy. However, they recognize that these lags can make it challenging to achieve specific economic outcomes. This perspective highlights the need for careful planning by central banks to avoid unintended consequences like inflation or recession. Such outcomes can impact efforts to reduce national debt and deficits effectively. In the context of Federal Reserve independence, conservatives might argue that these lags emphasize the importance of maintaining a stable and predictable monetary policy environment. Stability helps businesses and consumers make informed decisions, which is essential for economic growth and reducing national debt over time. So, the next time you hear about changes in monetary policy, remember the lags involved. They play a significant role in how quickly we see those changes reflected in our economy.